have loved being here this last month and talking about different home buying topics and home ownership topics. And so thank you for letting us guest speak and for joining us. So today's topic is going to be what's in a mortgage payment. And the objectives of today's class are going to be talking about how to understand your mortgage payment and what makes up your mortgage payment, as well as strategies for how to pay off your mortgage early or to save on the overall total cost of your mortgage. So to get started, let's just do a review as to what Stacy spoke about last week. A little bit, she shared this slide of the acronym. I call it usually PITI plus A. So PITI is one way to think of it. And the breakdown is the P stands for principal, the I stands for interest, the T for taxes, the other I for insurance, and then the A for association dues. So we're going to go over each individual of these components and exactly what they entail and the options that are available regarding them. So the first one being principal. Principal is, you can go to the next slide, JV, if you wouldn't mind. Principal is the amount that you are paying back that you borrowed. So it's the overall loan cost, the total that you're paying back that you borrowed, whereas the interest is what you are paying, the cost that you're paying due to the fact you are borrowing. So it's usually the lender charges you that based off of the amount and your interest rate, which we'll talk about here in a few other slides. It's usually reflected as an interest rate, so in a percentage form. So that's the PI portion. Then we have taxes. The taxes are assessed by local governments and counties to help be able to fund things such as schools, your police stations, fire departments, public roads, that kind of a thing. And it's calculated on an annual basis, but it will be part of your mortgage repayment, part of that payment. So how they take the total amount due and they divide it by the 12 months. So the total annual amount divided by 12 months, and you pay that as a part of your monthly payment. The lender can collect that payment and hold it in what is known as an escrow account until that time where your taxes do become due. So that escrow account, a mortgage escrow account, is a special holding account where both your property tax payments and your homeowner insurance premiums can be held. It's not an account where you go and make deposits or you pay money out of it like a regular checking or savings. The mortgage lender is the one who collects that on a monthly basis. So as part of your mortgage package, a portion of that payment, so that tax payment and that insurance payment, is set aside into that escrow account until the time is due for your taxes or your insurance premiums, and the mortgage lender actually takes that out and pays it in behalf of you. So that amount comes out of your escrow and then is paid. Let's go to the next one, which is the homeowners insurance. So now we've talked about the principal, the interest, the taxes, and now we're going to talk about one of the insurances that could that is a cost associated with your payment, and that is your homeowners insurance. So a homeowners insurance is going to be required by a lender, but it also gives you as the homeowner the peace of mind that knowing your asset is protected, that it's covered under the umbrella package of insurance. So where do I pay this? You can choose to, again, have your insurance be part of your mortgage payment. That would be put into that escrow account, and then at the time of which your insurance premiums are due, they would take it out of that escrow account for you. Who do you choose for homeowners insurance? So there are a lot of things when it comes to home buying. There's a few things that you can choose and a few things that you can't choose. When it comes to homeowners insurance, that is one of the things that you can choose. And consider bundling with your auto insurance to be able to help you save money. Usually if you package them together, as a bundle, then there is some advantages and reduced costs associated with that. So really quickly, before I move on to the next slide, I wanted to just explain to you, when I taught this class, or when I taught the home buyer class a month or two ago, somebody asked an awesome question that I've really never considered. And that was, why would someone consider not getting an escrow account? Or why would they choose not to do the escrow account as part of their mortgage package? And I kind of thought about it and I had some ideas, but I ended up asking our guest speaker lender who comes, and he said that some people choose not to because they might be able to hold that money, like save that money in their own type of account that is gaining interest. And so they want to be able to save that on their own and then pull it out when it comes time to pay for their insurance or their taxes. And then another thing he said, well, if somebody has the funds, but they maybe want to use their credit card to get bonus points or cash back or whatnot, then they would use it that way. Now, in my opinion, to me, I love having one less thing. It's kind of an automatic bill pay for me to have it as part of my mortgage payment, to just have it part of my mortgage payment, know that the lender is taking care of it in regards to having it withdrawn and then paid at the time that it's due. But it is an option for you to not have that. But just if you choose not to do it, make sure that you are doing some kind of revolving savings or something to be able to make sure that you are saving for the amount that when it comes due, that you're not like, there is a question in the chat that says, does it depend on the lender as well? Is it possible that some lenders would require you to escrow it? Absolutely. So you might have a lender who doesn't give you that choice in regards to whether to have an escrow or not. But I would say majority do give you that choice, but I would say there are some that might actually require it. Great question. Okay, so now let's talk about another type of insurance that might be a part of your payments. So this type of mortgage, or this insurance, is called mortgage insurance. Depending on the type of depending on the type of loan that you have, the name of what they call the mortgage insurance might be different. So for a conventional mortgage that we spoke about last week, if you have anything less than a 20% down payment, they're going to require you to have this mortgage insurance. And for a conventional, it is called private mortgage insurance. And for FHA loan, it is a mortgage insurance premium. And the reason why mortgage insurance is required is it just lowers the risk to the lender. You might, so there's a lot of things that factor how much this might be. Some of those things would be, or how much your monthly mortgage insurance, or how much your mortgage insurance is going to be. Down payment is one of those, your credit score is another, but keep in mind that the mortgage insurance is to protect the lender, not you. So it's a monthly expense that you have, or in the case of mortgage insurance premium, so for that FHA loan, there's actually an upfront mortgage insurance cost, as well as the USDA loan. There's an upfront one at the time of closing, in addition to a monthly cost. The only way to be able to get rid of mortgage insurance is once you have that right appropriate loan to value amount. So once you own at least 20% of that loan or of the house, then you will be able to, at that point, if you have a conventional loan, so that private mortgage insurance, you'll be able to have the option of refinancing it. Or when it becomes 70, when you own 22%, it will naturally fall off. But if you want it right at the 20%, you are going to have to request it. And they'll probably do an appraisal to make sure that you have reached that point. But at 78% is when it will naturally fall off. Whereas an FHA, the only way to get rid of that expense is by refinancing. They have the mortgage insurance premium is for the lifetime of the loan unless you refinance. So that is a little bit about this. Again, it's going to be a monthly amount that goes as part of the insurance package. And unless you have 20% down, you're going to have that most likely as an expense. Okay, let's go to the next slide. Here is an example on the loan estimate. And of course, the closing disclosure is going to look very, very similar. But here is an example. So you'll see here, I don't have the top part, the top section where it indicates what type of loan they have, but I can know that they have a conventional loan just due to the fact that you can see there years 1 through 7, they're going to be paying an $82 mortgage insurance, but come year 8 is when it's going to be estimated or calculated that they are going to own at least 20% of that, so that expense goes away. If you had an FHA loan, then that of course that 82 would continue to be there. Then you see down there, or right below the principal and interest, the mortgage insurance, and then the estimated escrow. So the estimated escrow as you go down is $206 per month. And you can see that they have decided to do both property taxes and homeowners insurance, and that estimate is included in the escrow. So that is an example as to what it would look like on a loan estimate and closing disclosure, how it kind of breaks up that PITI for you. Now keep in mind that there's one other expense depending on the type of housing that you purchase that isn't included right here, and that is the association dues. So some condos or co-ops are going to have a homeowners association fee that are paid directly to that homeowners association and that are not included in your mortgage payment. Upon request, you might be able to ask for it to be included in your escrow. I have actually not ever met anyone who has had that as an opportunity, but I did find a resource or a source on the Consumer Protection Bureau website that did say that that is a possibility with some lenders. If this is going to be an expense that you have, make sure that you factor it into your mortgage affordability. Keep in mind that, if it's an additional $50 or $60 expense that you're going to have to pay every month, that's something that if it's not included, because it is part of your housing expense, but not in your mortgage, you're going to need to set up some kind of automatic bill pay or reminder to be able to help you be able to pay that. So these fees are going to vary by location and possibly by even type of unit, whether it's a condo or a townhouse. And it doesn't even have to just be a condo or a townhouse. My sister owns this, or my sister is, her house is in a single family, residential area, but yet they have the HOA as well still. So keep that in mind, that just because it's not a condo or a townhouse, there still might be an HOA fee involved with it. Okay, let's move on. I found this very interesting. So Bankrate, back in late 2020, they did a survey on refinancing, because as we all know, the interest rates in the last year and a half have been at an all-time low. So they were doing a survey to see how many people were choosing to refinance. So more than 1 in 4 people in this country, they were able to determine don't know their interest rate on their mortgage, which is pretty crazy to me. And I don't know if it's just because of, lack of education in that aspect, or if they just, simply don't care. So I am here to help you be able to determine, if you don't currently know it, to go find out what it is, or to be able to be prepared so you can better understand what an interest rate is, as well as the APR and how they differ. So this next slide is going to indicate the difference between interest rate versus annual percentage rate. So the interest rate is the cost that you will pay each year to borrow the money, expressed at a percentage rate. This doesn't reflect other fees that might be charged that you have to pay during the loan. Whereas the APR, the annual percentage rate, measures at a more broader scale. And the APR reflects not just the interest rate, but any points, mortgage broker fees, any other charges that you might have on that loan. And because of that, your interest rate might be higher, your APR might be higher, your annual percentage rate might be higher than your actual interest rate. Okay. All right, so now I want to talk to you for a minute about discount points and what those are. So discount points are points that can help lower your interest rate by paying an upfront fee. By paying these points, you might pay more upfront, but it will give you a lower interest rate over the course of your loan. So probably less common right now, just due to the fact that interest rates are already low, that a lot of people probably don't care to quote buy them down with discount points. But I have an example here that I got from the CFPB website. You'll see there that the rate, you have two different rates there, 4.875 and then a 5%. You'll see that on the right side, they have chosen, the example is they have chosen not to pay down any with any discount points. Oops. And whereas the other one, they're going to pay it down. So you'll see here on the left side, the situation is you plan to keep your mortgage for a long time. So you want to have a more affordable long-term payment. So they've paid the points down to get that lowered, and they have agreed to pay the $675 more at closing to be able to get that 4.875% interest rate. So they'll pay that $675 at time of closing, which will help them pay $14 less each month. If you're ever curious about these kinds of things when you're working with your lender, you can always say, hey, can you give me a couple of options? What would it look like if I did buy down? You know, what would it look like if I didn't? And it can kind of give you an idea as to what it would look like depending on if you choose not to or not, or choose to or not. There we go. All right. The last thing that I wanted to talk about is home warranty and the distinction between that and how it's different than insurance. So home warranty is different. It's a contract that covers the cost of maintaining systems or appliances over a defined period of time. The annual cost roughly is averaged about $350 to $600. That does not mean that everything is covered. However, and it also does not mean that there won't be a service call fee or something to have somebody come out and look at those systems or look at whatever you are concerned about. Sometimes the seller pays this at the time of closing, or a real estate agent might give this as a gift at the time of closing. Usually just the first year, and which at that point you'll be able to find out, or you will be able to have the choice if you want to continue to have it and pay that cost yourself from year to year, or if you would decide not to. The reason this is kind of a nice opportunity is because you're taking a lot of risks when you buy a home. And sure, you can have an inspection. It's important to have an inspection and go in and make sure that your appliances are running, but it can definitely, things can change over the first 3 to 6 to 9 months of living in that home. And that home warranty can just give you some extra guarantee or extra confidence in that. I will say our seller, when we bought our home, our seller paid the first year for us, and we took advantage of some of the things that were on there. For example, rekeying the house. We got up to 6 doors for free rekeyed. So, and that's something we don't often consider is, hey, maybe changing the locks once we move in, or just that's one example. We see here in the chat, Christy Linson, when we bought our house, our air conditioner went out 2 months later. Yeah, so it was so great to have the warranty. Yeah, you never know. Okay, and they were able to 3 weeks before the warranty was able to help the fridge too. I am glad that you had that experience, because for me it was like we used the rekey thing, and then it seemed like everything started to fall apart after we decided not to renew it and it expired. So hopefully that's not that you have more of an example of Christy Lynn than mine. But okay, so now I'm going to turn the time over to Stacy. Stacy's going to talk about that second idea of how to be able to, over the course of our loan, be able to pay it off faster, and some techniques to be able to do
that. Okay, so as you've probably figured out, when most people buy a house, they don't usually just pay the total purchase price. Where most of us are not lucky enough to be able to be cash buyers. So we have to borrow money, and we borrow that money in form of a mortgage. And this allows us to own a home while paying over time. Because of the interest, the total cost of the loan will be much higher than the original purchase price. And the interest charged is added to the loan each month. And then interest is charged on that new loan balance. And this is called compounding interest. So it's not a simple loan where they just charge an interest rate on a sum and then amortize the payments out for the term of the loan. In this, you're actually being charged interest monthly, and then that is compounding. So it makes it so you end up paying a ton more over the life of the loan. Fortunately, a portion of your mortgage payment is applied just to the principal balance of the loan. So you will be building equity and you'll be decreasing the debt. So this is called amortization, and the mortgage will be amortized. This means the payment amount will remain the same, yet the ratio and the principal and interest payments will change over time. So you can see I have this little graphic that I found, and it shows where P is the principal and I is the interest. And even though you're paying the same chunk of money every month, that slowly adjusts that you are paying more and more to principal with each payment. There's also a sample amortization schedule here, and I've highlighted year 1 and year 25. So in the first year, you can see that the total payments for that first year are $13,176.72. And if you look over, $9,126.28 is going to interest. So that means only roughly $4,000, so it's actually $4,050 and some change, is being applied to principal. And if you continued on that way for 30 years, you would never pay this loan off. And you can see in the ending balance that it only changed that $4,000. So the borrower borrowed $230,000. They made roughly $13,000 of payments, but then their loan balance only decreased to $225,000. Now, if we move down and we look at year 25, for example, you'll see that that has changed over time. And in that table, in the 25th year, they're still paying $13,176, yet only $2,615 is being applied to interest. So you can see how eventually, as that shifts, the portions and the ratios shift, that eventually the loan will be paid off. But on this loan, it ends up that they borrowed $230,000, yet they end up paying a total of $395,298. So that's a total of $165,000 just in interest. So you're probably wondering, why get a mortgage? How can I reduce the interest that I've paid? And savvy homeowners, they will reduce the amount of interest paid over the life of the loan, and they'll end up paying off their mortgage quicker because each time they make a payment, more and more is going to principal. So there's a few ways that you can pay off your mortgage early, and by paying it off early and making these extra payments, you'll be saving on interest as well. So first, you can make more frequent payments, and you can do this yourself, or you can set it up with your lender where your mortgage is coming out automatically. Let's say it happens every 2 weeks. That would be a bi-weekly payment schedule. If you do that, you'll be paying more than your monthly payment every month. And when it all adds up, by the end of the year, you will have made one extra mortgage payment. The next idea is to make a lump sum payment each year. So you could use like a tax return or a bonus, like if you get commissions at work, you could pay extra to the principal amount. And the most important thing is just to make sure that you specify that that payment needs to go to principal, because there are other options. It could go to your escrow account. They could apply it to interest. So we just want to make sure that you specify that it goes to the principal amount. Another strategy for paying it off early is to just round up your payment amount. So if you have a mortgage payment of $1,345, you just round that up to $1,350, then you get $5 extra, or maybe you round it up to $1,400. There's a good chance that that $5 to $50, you would have spent it elsewhere anyway. And so you're just putting it to work for you. And even those small amounts can make a difference in the total payoff of the mortgage. I have a few examples here of how that works. And just to give you some numbers, so you can see the effects of paying extra. So with this example, and on the example that I showed you earlier, I used a mortgage for $230,000. I did a 30-year term. I did an interest rate of 4%, and their payment ends up being $1,098. So if you paid just an extra $20 a month, which for a lot of people, that's eating out one time or cutting something else, like maybe your daily drink run, an extra $20 a month on this loan would shorten the loan by 1 year. So it's not dramatic, but it's still a year sooner that you would pay it off. And it would save you $6,423 in interest. Okay. If you make that extra payment each year, whether you use a lump sum, like a commission check or a bonus or a tax return, that's just one payment. So it's a one-time payment of $1,098. It would actually shorten the loan by 4 years, which I feel like that's pretty significant on a 30-year loan. And it would save you $25,720 in interest. And again, that's just one extra payment a year. So you could do that by doing the lump sum, that one time, or you could do bi-weekly payments, and that would get you your extra payment per year. Plus, the nice thing about the bi-weekly payments is it's hitting multiple times at different ways that principal and interest are divided up. Because remember how the principal and interest, the ratio of what's being paid changes. Oh, go back a few. So you would be taking advantage of hitting that at different times throughout the loan if you did bi-weekly payments. Okay, you could also you could receive a lower interest rate. So this gives you a good motivation to either refinance or to shop for rates, because interest rates matter. So a lower interest rate. So if we did this same loan, same term, but we chose a 3% interest rate, our payment would be $969. And that lower interest rate would save them a total interest of $46,210. So you can see why shopping for an interest rate is important. Also, when you are a homeowner, considering refinancing is also a good suggestion. So when you're refinancing, you just want to make sure that what you're paying in closing costs, because it will cost you money to refinance, it'll be worth that you'll gain in saving in interest at least or more than what you're paying in closing costs. So you can see that extra payments really do make a big difference. And this same strategy can be used with your consumer debt that you might have right now on a credit card or a car loan. You can use these same strategies, make extra payments, and you will pay that off sooner. So I put PowerPay on here because you can visit powerpay.org and you can do your own calculations, enter your balances, your interest rate, your payment, and just play with the numbers and see what different amounts would affect the payoff time. So sometimes we get all excited about paying the mortgage off, but we haven't really considered whether it makes sense to make extra payments. So it's important that you evaluate how to use this extra money that you've found that you want to put on your mortgage. So here's some questions that you should ask yourself before you commit to making these extra payments. So first of all, does my mortgage have a prepayment penalty? So that's not super common these days to have a prepayment penalty on a mortgage, but it does happen. There have been loans that have prepayment penalties in the past. And so it's just important to be aware that you're not going to be penalized for paying the mortgage off early. And a prepayment penalty is just that. It's a fee because you didn't use the loan for the full term. All right, next question is, do I have a fully funded emergency fund? So if you don't have a fully funded emergency fund, I wouldn't recommend making extra payments to your mortgage. I would first fund that emergency fund, because when you pay extra on your mortgage, it's not like you can go back to the bank and say, oh, I've been paying an extra $200 every month. Can I have that back because I can't make my mortgage payment this month? They don't do it. They just keep the money that they've already received from you. So having that emergency fund is really important should you have something come up that prevents you from either making money, like the equivalent of what you need for your expenses, or if there's another factor that makes it so you can't meet your expenses in the month. So of course, consider that first. Next, would this money be better utilized in an investment? So it's important to compare how much you're going to save in interest on this mortgage versus how much you could gain in an investment account. And so if you have a really good investment account that has a high rate of return, you may prefer to invest the money, and that would be putting your money to better work for you. And then finally, am I able to meet all of my current expenses? Obviously, if you're not able to meet your current expenses, you shouldn't be paying extra on anything else. You need to make ends meet, evaluate your budget, make sure you can meet all of the expenses before you pay extra on your mortgage. Okay, so switching gears just a little bit, I want to talk to you about the closing disclosure. So there's a good sample, just like I referred to you to the loan estimate on the CFPB website. There's also a really good, Christy Lynn is putting in the chat, a really good closing disclosure explainer on the CFPB website. And the closing disclosure is another required document that needs to be given to you in a home purchase. And the lender will need to give this to you at least 3 business days prior to the closing date. And the closing disclosure is formatted very similar to the loan estimate that we've been introducing to you. So if you visit that website, you can go through and line by line, it'll tell you what each thing is, and maybe give you some tips for reading it and using this to your advantage. The nice thing about the closing disclosure is when they passed this legislation where they were requiring the loan estimate and the closing disclosure, our government was really concerned about consumers being able to understand the mortgage product. And so you will notice that the closing disclosure looks very, very similar. It's almost exactly formatted on the first page, exactly like the loan estimate. And so it's really easy to compare your loan estimate to your closing disclosure and see if anything has changed. I wanted to focus specifically on this loan calculations box though. And this just gives you an idea of what you will pay over the life of the loan. And it's formatted just like this box. So it'll show you the total payments that you will be making, including interest and mortgage insurance. It'll show you the finance charge. That's how much it's costing you to borrow the money. It'll show how much you financed or how much you are going to borrow. It will show the APR. So that's the cost of the loan expressed as an interest rate. And Mackenzie talked to us about this. And then finally, it will show you the total interest percentage, or the tip. And this is the total amount of interest that you will pay over the term, expressed as a percentage of the loan. So you'll see on this, it's 69, almost 69 and a half. So you're paying the full amount of the mortgage plus another 69 and a half. So if you're planning to stay in the home for the full term of this mortgage, and you're not going to be making extra payments, this number could be important to consider as you're shopping and just to consider when you're closing on your home. This number will change if you use these strategies that I've talked to you about today. And it just helps you realize the amount you'll be paying just in interest over the life of the loan, should you stick to all the original terms. And it's calculated by the amount financed divided by the finance charge. Just a few more things about the closing disclosure. I don't have another slide and I don't have an example, but it will be the first page will be like the page that Mackenzie showed you, where it talks about what kind of loan product you have and it breaks down the payment. And then the next couple of pages will actually itemize out your closing costs, and it will indicate whether those costs have changed, and it'll tell you whether they should have changed and what percentage they could change, like that they're allowed to change. And then the subsequent pages will have this on it. It'll talk about whether you have a prepayment penalty. It'll disclose who is doing your closing for the mortgage. It'll disclose who the seller is, who the realtor was, who the title company was. So all of this information is very important when you are getting a mortgage. So I think we're just going to ask for questions now. Does anybody have any questions?
I actually have a question. So we talked about points earlier, right? When you're buying down the interest rate. And I know you guys mentioned that if your situation is, for example, your plan is to live in that house forever, right? 30 years or 15 years, whatever your loan is like, that it's worth it to buy down the points. Some people won't live in that one house for that long. So what would you say is like the minimum number of years that a family or an individual would plan to stay in a particular home to make that points, buying down the interest rate, worth it?
I don't necessarily have a minimum number of years. Maybe Mackenzie does, but I will say it depends on the, like Christy Lynn is saying, it depends on the fee. So how much they're charging per point and how much you are reducing. And then you would actually calculate out, like, I'm trying to think of a good term for that, like the opportunity cost, I guess, of buying the points versus not buying the points. So do you save money by buying the points? And how long would it take you to get a return on that money? So if you were paying $2,000 to reduce the interest rate, how long would it take for the difference between the payment with the points and the payment without the points to make up that $2,000? Then I will also say, when I bought my current home, interest rates were okay. Like, I mean, interest rates honestly have been really good for quite a while. Like, we've been below 6% since I've been working in this industry. And I started working in this industry in like 2004. So we've had really good interest rates for a really long time. Like, if you're less than 6, we would always say, when I first started out, we're like, oh, you're getting less than a 6% interest rate. That's awesome. You can't go wrong. Well, interest rates have continued to go down over this time. So when I bought my home, interest rates were 4.5. So I was hearing interest rates are going to start rising. They're not going down. So I told my husband, we're going to buy points. And we did. And guess what? We ended up refinancing within 2 years because interest rates were just so
good,
nicely low. So we kind of ate it, but I feel like we ate that cost because we paid to get our interest rate down. But I was just certain, because I had been watching rates and they were going up, up, up. I thought they were going to be higher. And so I just felt like it was a good choice at the time. So sometimes, even though you're educated in these things, you still make a mistake. So it's fine. It all worked out. But like I see in the chat, if only we had a crystal ball, right?
Right.
So nobody really knows. But I suspect the interest rates are going to be rising
soon
in the future. Yeah, but right now interest rates are so good. I don't know. I don't know if it would be worth a buy down. I don't know if Mackenzie has an opinion on that though.
No, I would just say exactly what Stacy said. Looking at your opportunity cost in regards to what it will do for you versus like what we also taught about, which is just like paying more per month, is if you also make that as a pact of like, okay, sure, I can buy down and have 675 more in closing costs, but if I make a pact that I'm going to pay $20 more a month, then
That's
really,
true.
you're doing better than what the discount points could have really done for you anyway. So there's another question in the chat that I guess I want to make sure I'm understanding it correctly. So is there a rule of thumb about how long you should plan to live in a home before deciding to purchase or continue renting? So how, like, rule of thumb of how long you should rent before deciding to purchase or rent or keep renting? Is that what I, is that-
No, I was asking like, is there a rule of thumb about if you're gonna be purchasing, should you live in that house for X amount of years before, after what you paid in closing costs, after what you, because I hear a lot of these rules of thumb. I mean, there's a lot of rules of thumb in personal finance in general, but I kind of heard some thrown out there like, oh, if you're gonna buy a condo, you should plan to stay in it at least 10 years before. If you should buy a house, it should be 5 years. So I didn't know if there's any kind of general, if you might be relocating for a job in a couple of years, does it make sense to buy? That kind of thing. But that was just my curiosity.
Yeah, no, I mean, I would say I'll let Stacy say what she would think on that. I don't have any personal like rule of thumb, and I've never really heard what others will say. But I think that right now we have to keep in mind with the market that, it's not going to be your forever home per se, but you also want to keep in mind, am I okay with this if it has to be a longer term home than if you're thinking, oh, well, we'll just buy a 2 or 3 bedroom condo, but you already have maximum space, like you've got big enough family that you're using all those rooms and you're not done having kids, then you're recognizing already you're already buying smaller than what you plan to grow into. So I think just keeping like long term in mind, but also recognizing, am I buying something that if I was stuck here a little longer than what even my ideal is, would I be comfortable and happy with it? Because right now we're finding, like it's really easy to sell a house, but can you upgrade and get into a home that's bigger and what you want, that's still in your price range, So, and I don't know how long that we anticipate that to be, if that will change, So I think that's kind of what I would recommend is just think long term, but also keeping in mind, am I okay if for whatever reason my plan doesn't happen exactly in 3 years, but I have to end up staying here 6 years or something like that.
Yeah, I would agree with that because like I talked about this a few weeks ago, I think that most people end up staying in their home about 10 years. And that actually has increased over the last few years, partly because of the pandemic. People got kind of stuck where they're at. But then I would add that you want to make sure that what you're paying in closing costs is worth buying. So if you're paying closing costs and you're going to move in a couple of years, that's a lot of closing costs to essentially rent unless your market appreciates a lot. Because think about how interest is charged and you're paying all of this interest on every payment. And so really, you're not gaining a lot of equity. So if you sell within a couple of years, unless the market had appreciated a lot, you really may not have a lot of equity. So it comes down to what your financial goals are. I haven't heard a rule of thumb per se, like you should stay X amount of years. And Christy Lynn did point out, she thinks it would depend on how much you were putting down. And I think that is another thing. So if you're putting down enough that you're not paying private mortgage insurance and you do build quite a bit of equity just through your down payment, that would be beneficial. And it also reminds me, Christy Lynn reached out to me like a month ago from one of her students who was saying he had 2 scenarios. One was that he could buy a house and he could put down a really large down payment, or he could buy a house and put down the minimum down payment, but he had this chunk of change and he could just throw it on the mortgage after he closed. And he contacted Christy and said, every time I run this calculation, it looks like throwing the chunk of money after I close gives me a better deal than putting it on my down, like my initial down. So Christy and I kind of consulted about it, and we decided that that is true. And what you're looking at is when you put a big down payment, you're instantly building some equity and you're reducing how much you pay per month. If you just put down the minimum payment, then you're going to have a larger monthly house payment. However, if you have a chunk of money that you can throw on the principal, it wipes out so much interest faster. Where the down payment, the big down payment, just reduces how much you're actually borrowing, and then it amortizes it out over 30 years. Where if you put the smaller down payment and then you can afford that higher monthly payment, and then you throw that chunk on there, you've reduced it, so the balance so quickly, but it's still amortized out over the 30 years. Hopefully that makes sense. Anyway, any other questions?
Just a plug, please come take our home buyer class or tell your friends or family. We have the self-paced online course, both in English and Spanish. And then we teach the classes currently still via Zoom, but might be switching over to live again. So please come see me and Stacy. Well, me really. Stacy will be behind all the works, making sure it happens.
Well, here are some resources that they provided us. We are going to send a copy of this presentation to all of you and a copy of the recording as well, so you could listen or watch again after this. There's a lot of information shared today, really, really good ones though. So I wouldn't be surprised if we'll see on our records that this has been viewed many times and even with the previous ones. Thank you again for joining us today. Thank you for our friends from the Home Buyer Education Program for doing this with us for the month of June. It was surely a great opportunity to learn from you and with you for this month. And there's a lot of really good information that was shared this month. So thank you so much. If you visit our blog, utahmoneymoms.com, we have a lot of great articles on home buying this month as well. So if you're not following us on social media, please do. We are at Utah Money Moms on Facebook, on Instagram, and again, on the blog, utahmoneymoms.com. We'd love to hear your feedback on our webinars. You can scan this QR code. It will take you right to our survey. And we'll be announcing the winner for the drawing. I think next week, because this is our last one for this series. So please do, if you've watched, if you've attended all of the webinars this month, if you had four, you had more, four times you did the survey, you have 4 chances of winning. So please do, would love to hear your feedback so we could improve our courses. Thank you again for joining us. We hope to see you again soon. Please check out our website, finance.usu.edu/EFW, to learn more about our schedule and for our future webinars. Thanks, everybody. Have a great day.